So to date, Syndicate Room has raised over 15 million for their Access Fund. And overall, since 2013, they've been able to help over 180 companies and raise more than 250 million across 30 sectors. So they're sector agnostic, and their key business model is basically to find a super angel for their first round, and then the kind of average range of their fundraisings are about £500,000. So just a little bit of introduction about who we're going to meet today. So Fran O'Brien is head of clients and investments at SyndicateRoom that is based in Cambridge. So Fran is responsible for managing deal flow, all deal flow and liaisons with entrepreneurs at SyndicateRoom, which is a fintech company investing in startups. And she graduated from St. John's College in Cambridge and read history and psychology before she studied law in London. Before joining SyndicateRoom, Fran worked as a lawyer within Schools and Education Department, the London Borough of Ealing Council, and she joined SyndicateRoom in 2013 to immerse herself in a new challenge, which comes with kind of a young, rapid growing company that's really disruptive in the industry. So welcome, Fran.
Thank you ever so much, Holly.
Yeah. So we'll jump into some questions. I guess the first one that I have is, when do you think is the best time for entrepreneurs to start to engage with investors?
That's a great question. Okay, so I think in a casual, informal way, to engage with investors and having conversations with them at kind of event opportunities, whether they're online or hopefully kind of gatherings and networking events that will take place again soon, is something that you can start really, really early on. And you'd be surprised the number of investors that will turn up to those kinds of events and have just an open chat with you. And that's something that you can do right from day one with an idea and just bounce things off people. And it really, really helps to just kind of test things and do a bit of a triage on early ideas. If you're really serious about actually starting to engage investors for capital, and you're ready and you kind of thought about how much you want and what you're looking for in an investor and those sorts of things, the answer is really at the right time, which is when you have enough of a plan in place that you can go to them with a bit of a solid business plan that sets out your goals, how much you need, what you hope to achieve with that. I'm sure we'll touch on all of these different things during the course of the discussion today, so that you can have a meaningful conversation about the various elements of what you're hoping to get from the investment.
Yeah, that's a really interesting point. So I like the idea of engaging early, kind of light touch, casual meetings to introduce yourself and get sort of a network of investors to work with in the future. I like the idea of the meaningful conversations around the business plan. And I think entrepreneurs always develop a business plan, and I guess it's about making sure that it's really at a good level and not as refined as it could be. And so this goes back to that kind of meaningful discussion. So what 3 areas in the business plan do you think need to be of the most focus? I mean, obviously all of it's important, but what do you really think of the business plan are the 3 main goals that need to be really rock solid?
Sure. Okay, so I mean, if you're going to go into a serious conversation with an investor, I do think there are 3 main areas that you can focus on, and the product market fit, unit economics, or basically the financials, and the team. So taking each of those in turn, with a product market fit, what we're really saying here is anyone generally with a startup idea is very passionate about it and believes absolutely that the customers are out there and they're going to want to use the product or the service, and they're definitely going to take it on. That makes sense. But the thing is that actually customers can be surprisingly wedded to really dysfunctional incumbent things that they're doing. Let's say you're a software company and you have a great solution to something, and you know that the existing approach that companies are taking is just fumbling together in Excel. Well, you might find that actually that Excel works pretty well for that purpose. So how are you really going to disrupt that and make sure that they really do need it? And how are you going to show to an investor that you've gone not just to the step of showing that there's a use case, but that people will actually pay money for it? And who is going to pay money for it, which I suppose touches already on audience, but who is going to pay money for it? How much are they going to pay? And have you actually had conversations with them? Could you point to particular potential customers? Better still, could you point to contracts or suggested contracts that could be in place if you got the capital that would enable you to start moving? So that's really important. It doesn't have to be huge amounts of market research. You don't need that, although it helps. The more you can do to demonstrate the robustness of the case for the product market fit is going to be really important. The second one, the unit economics, which sounds sort of incredibly intimidating, but is actually awfully simple. And it's really just, it's thinking about how much money do I actually need to service an initial set of customers with what I'm making or what I'm offering? Do I think I need 4 developers or 8, and why? What are the other human resources requirements? Do I need office space? What do I need to, what actually goes into this, the nuts and bolts and the parts? Have you tested that with a prototype? Can you? And once you have those in place, you do have enough to put together a base financial model, and you will need that because investors will expect it, and they won't expect it to be perfect. And I've never known an investor hold a company to exact unit economics, but it's about showing that you've thought about all the components that go into the cost of something, and that as a result that you need about X amount. Maybe you've added 10% for some buffer, but you've thought about it. And then the last thing, if you're really going to focus on 3 things and really hone in, would be the team. It's rare, not by any means unheard of, but rare to see even an angel investor, so very early stage investors, necessarily want to invest in a company where it's just the one founder and they don't have, say, skills. They've not worked out what their gaps are and weaknesses are, and they've not tried to bolster those with skills from the outside. So generally, you want to see that the founder has put in place a core team that can at least deliver for 6 months, 12 months to get things out, to get a bit of a runway, to get the product or service out there, and to show that you can cover the core ground that's going to be required to do that. Of course, sometimes it's a bit chicken and egg because, of course, you need money to pay people to have a team.
Yeah, absolutely.
But you can show who you want to hire and in what order. And you can show what you think it's going to cost to get the kind of skill level that you need for different people and what kind of experience or knowledge that they might need. And it's about really putting that together and doing the research and showing that you've done your homework. It's like anything, that you've really thought about the requirements. And it's okay if they're going to be a little bit out down the line, but show that you've really thought about the key parts.
Yeah, so thanks for that. So product market fit, the unit economics and team. Thanks, Fran, for outlining those. I wanted to dig a little bit into the unit economics because I think when I work with entrepreneurs, I think I kind of work on a 3-year plan of they need to have a budget and understanding of a 3-year plan. But one of the things that you mentioned is to be able to deliver that product to that first set of customers. So would you say that there's a time, do you suggest that entrepreneurs have a time frame, or is it just to kind of target that first initial?
Sure.
Launch?
Well, let's say that you're 6 months in and you've got an investor asking you for a 5-year plan. I would question that investor because in all honesty, it's guesswork when you're getting too far out. Having said that, it is pretty standard for an investor to want to see a 3-year plan. And partly it's not really about the exact numbers that are in there. In fact, it's almost not about that at all. It's about the line items that are on there. And it's about showing that you've thought about where your costs are going to be and that you're demonstrating that you understand the different elements of how the business is put together and how that could change over time and the potential to scale. And that as you scale or as you move forward in time, if things are going well, especially if things are going well, what are you going to need more of? What are you going to need less of? Where are your costs going to come from? And I think people get really caught up thinking that it's a game of getting all the numbers exactly right. But it's actually more about the underlying assumptions that are going into that model that the investor is testing.
Okay. Yeah, that's really good feedback. I think that's all. I mean, the business plan is always one of the key things that I think getting that to the right stage at the right time is probably something you experience as well as you shift through lots of different applications from entrepreneurs. Do you have any questions that have been placed to the panel? This might be a good time to weave in a few questions.
Yes, there is Nauni Devi asking, sourcing funding for social innovation is a bit different as ROI is not a priority. And I assume most investor would like to know when they will get their return.
Good question.
How do you start approaching investors if you're in that situation?
Oh, that's a great question. What you want to find is the right kind of investor. And you will hear this time and time again. It's about finding the right fit. So there are, not surprisingly, a lot of investors out there that are very, very mindful of return on investment above all else. They're a business, they're out to make money, and the corporate social side or the environmental benefits or whatever other kind of positives that could be there are going to be secondary. But there are so many investors at all stages, once you start kind of really trying to go through the options, that are actually primarily more interested in other topics, and they tend to be sector specific. They tend to have certain interests. So and one that springs to mind straight away, although it's a little bit later stage, is an investor called Mustard Seed. They are really, really geared towards finding socially responsible investments, and that's their priority. And then you have others that are, say, really trying to make sure that women are being funded or that minorities are being funded. So what it boils down to is taking the time. Again, it can be going to events, speaking to different people, really going through LinkedIn as well can be a good way to do it with the right search terms, to get a short list of investors that you think are interested in what you specifically are doing. And that generally helps a lot.
Yeah, thanks. Good question, Nolly. And thanks, Fran, really helpful. I like the idea of the list of investors. I think tackling the approach to gating investment has to be a real orchestration, if you will, like a military precision carried out with lots of planning and work put into it. Is there any kind of suggestions that you would give to entrepreneurs on sort of their approach to looking for the right investor?
Yeah, I think, and it's one of those funny things, the immediate thing you end up thinking about is how do you find the right person in a relationship? And it's not too dissimilar. I think actually the first thing you have to solve is, what are you actually looking for yourself? What do you want in an investor? Is it just the cash? Is it, which hopefully wouldn't be the case in a relationship as I make these parallels, is it just the cash? Do you want them to be not too involved and hands-off? Do you want their sector expertise? Do you want them to make warm introductions to potential customers? Do you think that they have, legal services or accountancy services that you could take advantage of that would save you some costs? There are investors out there that will do all sorts of different things or nothing, depending on what you want. So if you can get together a list of what you're looking for, that's a great start, because then you can start doing some research, perhaps initially, if you're new to it, online. There are lists available online. There are generally, investors will put up profiles in different places like Crunchbase and AngelList. So you don't just have to scroll through their individual websites that tell you a bit about their priorities as an investor. And then you can try again. It's about trying to narrow down that list. And before you contact them, if you can, see if you can get a warm introduction to that investor. Because as with any relationship, that just always goes a really long way. And it means that you've kind of got an in that means a little bit more than a cold email or a cold call. And it's all too easy. I would know myself. I'm guilty of it too. It's all too easy to ignore a LinkedIn message or a call or an email that's just kind of come in, because there's a lot of noise out there, and it's that much easier to pay attention when it's come from a warm introduction. Now that can be very difficult to achieve. So the next best thing is really prep that contact that you make. If it's going to be through LinkedIn or on an email, you plan that message. And just like applying for a job or anything else, make sure that you've really demonstrated in that message, that first contact, why you're getting in touch with them specifically, and show why you think that they could be the right fit, really upfront, to prevent you just ending up in the list of companies that perhaps they're just not going to necessarily respond to at great length.
Yeah, Fran, really good actionable insights. I think if you can't get a warm introduction, sort of the best way to approach it, if you're not able to obtain that, then some good suggestions.
It is a challenge, admittedly. I don't say it lightly. Getting a warm introduction is a difficult thing to do, and it takes time and a lot of effort, and it's not easy, but there are ways around it.
Yeah. So one of the questions that I had was, what are the top 3 reasons why SyndicateRoom would pass on investing in a company that potentially you look at? So I'm assuming that you have lots of entrepreneurs that are presenting their proposals to you for investment, and so what are the main reasons why you decide not to invest? Because I think that's kind of helpful for entrepreneurs to know. Sure.
Well, for us especially, but most investors really, who are operating as a fund or an institution, we have very specific initial criteria. And for us, one of those is that the company has already sourced an angel of the quality we referred to earlier, of super angel. Now, they're not necessarily going to know if the angel they've sourced is a super angel or not, but it's clear enough from our website and everything that a company might read about us that we only co-invest. And that we don't make the first move. We would need an angel to be on board already. So one of the more frustrating things can be, lots of cold contact about, business plans or very early stage propositions, looking for investment from us and expecting to be reviewed by us. Here's my cap table. Here, not my cap table necessarily, because of course they might not have investment, but here's my business plan. Here's my presentation, without having kind of sussed that actually we only co-invest, so focus in on that. And it's going to be the same for other investors, but it will be different initial criteria.
Okay.
The next thing, if you get past that, would be just sort of not necessarily having things ready. So we talked earlier about those kind of 3 things: product market fit, the unit economics, the team. You expect robust answers to those straight away. And it's just a big red flag not to get them. And they don't need to be perfect, but they need to be, good enough, clear enough, well presented. And I think, speaking of, I think the last one perhaps can be presentation. If something's very, very sloppy, poorly delivered, there's no sense that the company has any kind of cohesive brand or sense of identity yet. Actually, that can be a very difficult company to assess. And it's something I could talk about at great length, but actually I would suggest to a company at any stage that's serious about investment, have a website. It doesn't need to be a complicated website. It can be a landing page. It can be very simple. Have a little bit of a sense of identity, a description of who you are. Have the very bare bones of what could be described as a brand. You can work on it later. But a complete lack of any image can be very difficult, and it can make it a bit difficult for an investor to connect with you. And that can be surprisingly important. It just sends this message that you're not ready, that you've not really thought about it, that you think that that's something for later. And developing it is. Developing that is for later. But having just something initially is something that we all know we can do. We don't need to be coders to build a website landing page. Anyone can do that. So that's a kind of an expectation these days, to have something basic there.
That's really interesting. I never would have thought of that. But kind of being a little bit bland and not kind of having something, and there's so many different options out there, like crowdfunding marketing logo. I used one actually for a company I was working with, and it's so easy to just have that ready. So interesting that's one of the reasons. Of course, it's the whole picture,
Of course.
But yeah, thanks for sharing that, Fran. We have lots of questions coming in, so I'm gonna dig into some of them.
Great.
So,
yeah.
The first one is from Bartos, and he or she says, convertible debt versus equity investment. What is the general standard, in your opinion, at early angel stage?
So for early angel stage, that's actually really easy to answer. If you're based in the UK, angels really want EIS. EIS is the tax incentive scheme set up by HMRC. Yeah. It means that for angels that are investing either large sums or have very diversified portfolios, or whatever it may be, even if they're not as experienced angels, this tax incentive is hugely valuable to them. And so you need to really set up an equity round for them to benefit from that. Mm-hmm. And the first £150,000 that you raise can be set up on an SEIS basis. Yeah. And the investor essentially is only at risk for, give or take, about 50% of the investment that they outlay. That's how attractive it is to the investor. Yeah. And then the next amount of money, so after that 150 up to about 5 million or so that the company raises, is generally eligible for the EIS scheme. And again, it's about 30% then that's sort of covered. That's probably not the right word to use, but by the government, and the 70%, give or take, that's at risk. And CLNs, convertible loan note options, typically won't offer that. So what you end up having to do to compete is make sure that the CLN will price in the difference for the EIS benefit that the angel would otherwise be getting. And some angels simply won't invest without EIS or the SEIS. So that, I know that's taking it off on a very specific tangent, but in the real life conversations, that is going to be the primary concern. As a business, it doesn't make a huge difference. And I hear people sometimes saying that kind of a CLN approach is a way to hold off on having to value the company, but it isn't really, because the investment will convert into shares when you have the next funding round, and there'll be a push from investors for that to be fairly soon, and there'll often be various cutoff points and so on that you have to build into the CLN. If you're desperate to buy some time and not have to value because you are so sure that you're going to have a massive inflection change in valuation in maybe the next 6 months, that would be a really good reason to do it. But other than that, equity tends to be simpler, and you will end up having those conversations around the EIS.
Okay, yeah, of course, especially in the UK. Yeah, thanks for that. We have another one coming from Lucy. Are there points to look out for when talking to potential investors that don't have a track record, that does not yet have a track record in the investor space, but invest mainly in businesses that the individual's company is in? Does that?
So my reading of that question is should you be wary of investors that don't have a track record, or should you ask different questions?
Yes, I think that's what the attendee is suggesting. So are there points that they should look out for if there's no track record in the space, but they do invest in that sort of market? So for instance, if this individual is in health tech, for instance, and they don't have a lot of track record, but that's their experience, would you suggest some things if they don't have a track record?
Sure. Yes, and I think they may have just clarified as well. The question is what questions to ask if they don't have a track record? Okay, so really good question, because it's definitely helpful to see if an investor does have a track record, because you've then got that information right there about them to go on. Yeah. If you're really looking for an investor that has a track record in a particular sector, perhaps consider that they could come on board as a kind of cash investor, but alongside another investor with the sector experience, if that's really, really important to you. So you don't need to kind of turn them away, but maybe they're not your lead investor, or the person that you're really speaking to about the crux of the round and the core of bringing it together. If the question on track record is more about, say, establishing that they're trustworthy or that they're good to work with. Regardless of sector or anything else, if you can try and get in touch with any companies that they have worked with before, which again can sort of be done through LinkedIn, possibly, if you can get some information, or you can even ask them, would you mind if I had a word with one or two of your investee companies and just kind of asked about that experience? There's no reason why, as a company, you shouldn't be doing due diligence on the investor as well. This is a two-way relationship. So that's one way that you could do that. If you really can't find out any information about them and they're not forthcoming with information about themselves, enough that you can get comfortable with who they are and who their background is, then, yes, that's going to be trickier, and maybe kind of hold those conversations off until you have one or two more established investors, rather than, having them as the crux. I think that way you kind of hopefully get them come in, but you're not kind of hitching your wagon to an unknown quantity, if that's making sense.
Yeah, I like your analogy of the relationship, because once you have an investor, yes, you have a relationship for a very long time until, so it's really important. So good question. Thanks for that one. We have quite a few people that are logging into the webinar outside of the UK, so from around the world. So we have one question from a friend of Oxentia, Adam Irvine. He's asking about potential investors. Which countries outside of the UK would you recommend targeting?
I mean, I don't know that there's a broad brush answer, just generically. I suppose it depends on, you could answer that by sort of thinking about where else has a really established tech space, or where else is healthcare investing, a really big developed thing, or for whatever other sector it might be. You do tend to find that if it's a case of just thinking pragmatically, you can run into issues jurisdictionally with kind of, say, setting up legal documents. If you're looking for investors, maybe who, you've got a language barrier or a jurisdiction barrier, and you might end up with documents that need to be translated. And it's sort of a really overly practical point, but, I've seen it happen. It can tie things up a lot. Or legal frameworks or regulatory frameworks that you're not familiar with and that you don't really know the implications of. And so in those instances, if you can see that the investor understands those and is experienced in those, so that they can kind of handle that side for you, and then you don't have to worry so much about the jurisdictional side, then that's not really an issue, because you're not having to take on the responsibility of figuring it all out. And if it's angel investors, and sort of individuals who are just interested in putting capital into your business, then, I mean, they could really be based anywhere. And it's generally sensible to, do your homework on them a little bit, and just sort of make sure that you know who they are, and get a bit of background about them. But there's no real reason why you couldn't take capital from a private investor based anywhere. So it does sort of depend on a few different factors. I hope that answers the question.
No, that was a really good one, because it's always difficult. But the point about angel investors is potentially a good option if you're looking for. And your other comment about a sector, it's good. It's going to be quite different. For instance, in the health sector versus tech sector, pharmaceutical sector, it may be different based on. Good. So thanks for that. So we another question that I was interested in is this topic of valuation that all investors and entrepreneurs are always concerned about, and I guess from various different viewpoints. But where would entrepreneurs start with kind of setting a valuation? In the UK, I think it would be helpful, because I know it's different in different countries. India is different than other countries, but where would you recommend they start?
Yeah. So that's one of the questions I get asked most. It makes sense why, because it's quite a fraught moment for a business when you're trying to work out, what am I actually worth? I don't want to overvalue myself, undervalue myself. I want to have a serious conversation. generally speaking, the best thing that you can do is not get caught up in things like the technical ways that companies can be valued. So, I'm not even going to go into them, but looking at revenue, looking at multiples, looking at all sorts of specifics around the financials until you get to a much later stage. What it's really about early days is a really frank conversation with picking maybe one, possibly two at most, to start off with investors, and asking them what they think you're worth at this stage, and marrying that with information that you can find, and it's all readily available online, about companies that are of a similar stage and development to you at this point. And you can do this through Companies House. That would be quite a mission, or I would recommend a platform called Bowhurst, which produces a lot of kind of free reports on different sectors that you could kind of read, and that would help get a kind of a ballpark. And it will generally show that for a very, very first round, a valuation of a couple of £100,000 it sounds incredibly low, but is actually probably about right. And that the more you push upwards towards the millions, the more you're going to have to show that you've already done. And it is, of course, going to depend then on the conversation you have with these early investors. And you will almost certainly find that, you'll shoot a little bit higher, they'll bring you down a bit, and then you'll end up somewhere in the middle. Yeah. But the best thing that you can do to justify the valuation you want is point to market comparables and show that, we're modeling our growth potential on X company, which is in the same space. Let's say they did something in a little bit similar, or, because they're going to be an identical company, of course, otherwise why would you be starting your company? But you can show that there's a trajectory that you would like to map onto. And if you can point to 2 or 3 companies that had a valuation that you think's about right for you at the same sort of stage that you're at, it makes it very difficult for anyone to argue against it, because you've got it there in black and white that this is what you think you should be worth. And it tends to work very well in those conversations.
Okay. Yeah, I like the market comparable. I think not that it's the easiest, but it's the less time intensive from a number crunching perspective. Trying to put a financial model together and try and project revenue over the next 10 years.
It's great. It's wonderful, but it's a lot of hot air a lot of the time, and investors know that until you get a little bit later. So this question is very dependent on stage and whether you've had a previous funding round or not, and the sector that you're in. And Holly, I completely agree. There's going to be times when you are going to be expected to look at it and do it that way. But if you're really, really early on, or even if you're kind of midway point, but let's say pre-revenue especially, market comparables are going to be essential in that conversation.
Yeah. Well, on the market comparison, and so my experience with market comparison is it's helpful to see the movement in the market. So this company bought this company and, they exited, or this company, did this company. So you can see lots of movement. But I found it difficult to figure out what the sale of that was, or the exit of what that was. So is Bowhurst in a way to look for those exact numbers?
Yes.
Of that. Okay.
It is. Bowhurst is a great way to do research on market and space. And so even before you get to, let's say, a trade sale where, one company is buying another and you're working out what they're worth, and you're projecting, say, the valuation of a future round, you can even track back a company's fundraising history right back to the very earliest days and the first fundraise that they did. And see what they were valued at right there at the very, very beginning, and how that inflection point changed over time. And if you're prepared to spend, half a day, it doesn't need to be loads of time, but just doing a bit of research about that company and the experience they went through in their growth, you can see what they had at that first value inflection point, and you can see how well you map onto that, and you can make arguments accordingly. Companies often, and we're all guilty of it really, but we can fall foul of the sense that that we're the first to ever do anything remotely like what we're doing. I feel this often with the fund that we have. We must be the first ever kind that does this. But generally speaking, there will be, if not a competitor, certainly a really kind of solid example, and it may even be in a different sector, of a company that's got a similar sort of unit economics, let's say, to you in particular, because that's really the basis of what we're talking about here with valuation. And they had to go through a journey that's the sort of journey you expect to go through. And that information, so Bowhurst tracks companies' house data. So it looks at all of the kind of filings and fundraisings that companies go through. And as I say, they also produce, so I mean, sometimes you do have to kind of get an account with them to get a lot of the information, but they produce a lot of reports as well that are just freely accessible and available. And oftentimes that can be all the information that you need.
Yeah, good point. Crunchbase also, it shows funding
absolutely right.
as well. Yeah,
it's not. Bowhurst is a little bit more complete for the early stage, and PitchBook is then really much more complete for the later stage, the VC stage. But it's very expensive, and it's typically aimed at institutions such as Crunchbase would be a great place to start if you just want some easy access base information, but it can be a little bit incomplete.
Good. Well, I think we'll wrap it up, Fran. I think that was a really excellent sort of introduction into getting ready, getting investment. I think some of the highlights that I took away were to ensure you're investment ready, make sure your business plan is the right product market fit, that the unit economics make sense, and that the team or plan to hire your team is kind of well thought out. I think when you're looking for investment, there's lots of different options of where to find the right investment, whether that's with a professional organization like yourself, or like SyndicateRoom, or potentially an angel investor, to work with investors that potentially don't have a track record. There's your suggestions on not using them as a lead investor. I thought was really helpful. I think that's a really good point. And then the three reasons why SyndicateRoom may not choose to invest is, obviously, your super angel model, which is really interesting. I recommend everyone to go to SyndicateRoom and look at that. It's quite interesting. Lots of different tools on investors as well. Making sure those top three things are solid in the business plan. Maybe if those aren't a little bit on the weaker side, and the presentation brand, and have a website. Put a little pizzazz on something and make it look a bit shiny.
Yeah, I know it sounds desperately superficial, but it's true. It shows that you've thought about it and that you're serious about your business.
Yeah, and then some resources for a relatively easier way to approach valuation, I think, in your business plan is the market comparison. And I think your suggestion about PitchBook, Crunchbase, that we all know, and Bowhurst, I think that's potentially something that people can look into. Obviously, there might be some fees associated with those, but a place to start, I think, to investigate though. And I find Google really good as well.
Yeah, absolutely. Yeah,
always kind of find some real gems in there. So thank you to Fran and SyndicateRoom for joining us, and everybody that joined the webinar. Lots of good questions that we didn't get a chance to get to, but feel free to reach out to us at Accenture if you have any additional questions. And enjoy the first night of lockdown free or modified, I guess, depending on where you are.
Thanks ever so much, Holly. Really appreciate it. I hope people have found it helpful. And please do reach out with any further questions. We're very happy to help.
Great. Excellent. Thanks, Fran. Bye now.
Thank you all. Bye-bye.
Bye, everyone.